Good day, and welcome back to the Life License Qualification Program presented by Business Career College Corporation. My name is Jason Watt. I'm one of the full-time instructors and owners at Business Career College. I hope that you're finding your studies enjoyable and engaging. We're going to be, for the next roughly hour or so, working through some concepts specifically related to life insurance. Now, life insurance is not a new idea, not by any stretch. We see ideas around life insurance date back as far as 5,000 years. You'd find it in virtually every ancient civilization. However, in modern times, we really don't see the reintroduction of life insurance until the mid-1500s. And what we saw in the mid-1500s, we saw folks in the United Kingdom, in England specifically, who made a decision that we still see people make sometimes today. What would happen, we would have somebody born in a small town in rural England. And that person was born to somebody whose profession was, let's say, farming. So if you were born to the farmer, you knew that you were going to grow up to be the farmer. If you were born to the town miller, you knew that you were going to grow up to be the town miller. If you were born to the town smith, you knew that you were going to grow up to be the town smith. It was very much the case that we had this linear progression, and that if you wanted to get outside of that progression, if you wanted to look for new opportunities, if you wanted to meet new people, if you wanted to get an education, learn a trade, then the only way to do that would be to move to the big city. Now, that carried a downside with it. And we still see this today to some extent. That if we have a tragedy occur in a small town, the loss of a primary breadwinner to some sort of accident, for example, then typically, within a small community or small town, we'll see people band together and they will offer all kinds of support for the family that has recently suffered a loss. Well, that idea was a little bit more pronounced in England in the mid-1500s. That is, if you had a loss in a small community, then you knew that somebody would step in and take over the caregiver responsibility for your children, for example. You knew that your spouse was going to have some employment that they would be able to find. But if you moved to the big city, you lost that social safety network. In fact, we see some stories about this. If you happen to be a fan of literature, you'll have read stories by people like Charles Dickens, or maybe you've seen plays like Les Miserables, which are very much about this type of situation where we have a family where the breadwinner is no longer around, and now it leaves the mother, possibly, the kids, to fend for themselves. And this is not a situation that you would probably choose to leave your loved ones in. There was not much in the way of employment prospects for single women in big cities in England in the mid-1500s, and the children would often end up in orphanages that were really little better than slave labor. So we didn't want to send our families in that direction, so what arose in response to this need was life insurance. Now, at that time, if you went to buy life insurance, you were buying a very rudimentary product. By this point in the course, you've already learned about the idea of mortality and mortality tables, for example. Well, in the mid-1500s, we did not have sophisticated mortality tables. Yes, in Roman times, there were some mortality tables created, but use of those mortality tables fell out of favor through the Dark Ages. That idea of using a mortality table to explain when somebody might die was really considered heretical. So it really was like ordering off of a menu. If you wanted to buy a certain amount of life insurance, you would pay this much premium, and then if something happened to you, there would be this much death benefit. We didn't have sophisticated applications like we see today. The information that you saw discussed in modules 2, 3, and 4 that we would gather as far as medical information, personal information, lifestyle information, would not have been gathered in those days. It would have been more like going into a fast food restaurant, picking out the amount of life insurance you wanted, and paying the corresponding premium. There was not a consideration for mortality, there was not a consideration for your health. There may have been some consideration for the job that you did, but really little else. Now, those first insurance products were very simple. It's what we would really call today a one-year, non-renewable term product. That is, you would acquire this insurance, you would pay your premium, let's say on today's date, let's say on July the 22nd, and you would know that you would be covered up until next July 22nd. and at that point, your coverage would end. Very simple. The premium you paid here results in coverage here. If something happens to you during that year, a death benefit is paid to your spouse or whoever you happen to have named as beneficiary. But on this date, the coverage would run out. If you wanted more coverage from this date on, you would just go back to that same assurance society and you would pay your premium and you would have coverage again for 1 year. A fairly simple process. Now, thankfully, life insurance has gotten a little bit more sophisticated.